My name is Joydip Gupta, and we'll be talking today about some of the best practices that we have, as Synaptic, have seen NBFCs in India and a little bit outside India and Asia are doing to prepare themselves for post-COVID world. So a little bit about myself and the company. I have about 23, 24 years of experience in a whole bunch of different things. Did some consulting work, have moved around the world a little bit. I've spent a considerable amount of time in analytics and fintech. Synaptic, we are a US-based company, and therefore serve a lot of global banks out of our US office. But most of our people are in India, in our Bangalore office, and we also have a couple of people in other cities like Mumbai. And 80% of our people are in India, and we support our Indian clients and now increasingly APAC clients in Middle East and South Asia out of our India office. So with that, let's jump into the agenda. So I have structured the agenda in a why, what, and how format. Let me just make sure. On the why, what, and how format. So first, I want to spend a few slides on why it's important and urgent to do some of the things that we're going to talk about in the next few minutes. So how is COVID in particular impacting lending? And I'll show you some numbers and stats, but I think most of the high level stats everybody knows. The thing we're going to look at here is, so what, right? So if COVID has had certain impact on our customer base, on our borrowers, so what does that mean for our decisioning and models? Then we're going to talk about the what. What are some of the top lenders doing to prepare for a post-COVID world? So I personally have had very deep discussions with at least 125, 130 NBFCs in the past year and a half, with either the founders or the chief risk officers or head of lending or analytics. And what I have found is that 95% of NBFCs in India are actually still trying to figure out how to recover from COVID, right? They're figuring out new ways to increase origination. They're looking at collections efficiency. Some of them are luckier than others. Their target segments haven't been impacted as much. But then there is this 5 or 10% of NBFCs that are very silently building out certain capabilities in terms of process, in terms of technology, in terms of analytical models that we feel as a company will definitely help them get a control over their business during COVID and will place them in a much better situation competitively post-COVID. So that's what we want to talk about now. We've kind of converged them into a few themes where we'll talk about what some of these top lenders are doing. And then I want to spend most of the time on the how. So great, we know what these guys are doing. How can I, as an NBFC, given my constrained resources, technology, budgets, what can I do to mimic some of these best practices? Okay. So first, we'll look at the why. Let's look at some of the stats and the so whats of how COVID is impacting us. So, I won't go through some of the charts in detail, but high level, you'll see that COVID has spiked unemployment. Now, depending on what data source you look at, some people are saying unemployment is coming down, and some of them are saying it's still high. On the right-hand side, this is a business resumption index. Basically says that small and medium businesses and large corporates are slowly resuming, but they're still below what they used to be before COVID, right? Now, most of the discussion that I'll focus on is on consumers and SME, MSME. Obviously, we know that MSMEs have been hardest hit by COVID. So while overall charts look grand, the smallest of them have been hit the hardest. So great, we all know that. So what? So basically, your risk scorecards and policies for evaluating your customers that you had that were working beautifully pre-COVID may not work anymore. So you've got to do something about these scorecards and policies, right? And these 5-10% of the best NBFCs are, again, have already started doing a few things that we'll talk about. The second thing is your non-performing assets are very likely to increase. Again, no surprises. You look at all the numbers on the right-hand side. Basically, what you'll see is if you look at employment or productivity, you look at the last 3 to 10 years, and then you look at the current year, FY 20 to 22, which is this year and the year that's about to end, and then next year, there's a drop, right? No one can deny it. And then depending on what report you look at, it's climbing up slightly, and it'll take a while for it to completely get up to pre-COVID levels and then grow, right? Now, we all know that, right? Your NPAs are going to increase. But therefore, what is it that these great companies are doing to take control of the situation? They are building an early warning system. So you know that a lot of your customers are going to default. So what if you had a magic crystal ball that told you 2 or 3 months before they defaulted that out of your 10,000 customers, here are the 300 that are at highest risk of default, right? So that you could do something about them proactively. So we'll talk about what these companies are doing to build out an early warning system and how can we build it within our own NBFC. And then the third one is the future is unpredictable. Again, no surprise there, right? Again, you can look at all these data. Basically what it says is that, again, in the future, things will take a while to get back to normal. And every month, every quarter, things are going to be wobbly and unpredictable. That's what COVID has taught us, right? So what, right? So basically the takeaway is that you need to build an environment that allows you to quickly test and learn and experiment as the situation evolves, right? You can build a great model, but as we all know, models have to be stable, right? You can't be changing a model every 2 to 3 months, but the situation will change because of the unpredictability. So what is it that we can do to create an environment using technology, processes, and people to test and learn and experiment as we see new things and continue to be very flexible and dynamic and nimble. So, some great man has said that times are tough, but during tough times, it is during tough times that some businesses innovate the best. And we are seeing that, albeit in very small part of our NBFC community. Some companies are innovating. And this innovation is not just to get better during COVID times, but really to get much, much ahead of the competition when the economy does turn around. So to summarize, let's go to the next section on what, right? So what are these great guys doing to prepare themselves? The first thing they're doing is they're looking at alternate data, right? So again, all of you guys probably are looking at some sorts of alternate data. So what I want to do in the next few slides is first look at what are all the different types of alternate data that you could be looking at, right? Not everybody's looking at everything. The second thing that these guys are doing is switching over to AI in their models. We'll talk a little bit about what you can do to improve your models a little bit, looking at COVID, and then when should you think about moving to AI and what can you do about it? The second thing that these top lenders are doing, as I said before, is building out an experimentation-friendly environment, knowing that things are going to be unpredictable in the future, right? So what is a test and learn environment? It's an analytical environment, rapidly run experiments and identify strategies that work best for different customer segments. So you will have different segments, and this is not just different verticals, right? You could say that, look, I'm lending to SMEs and MSMEs, and it looks like smallest of my customers who have turnovers of less than 1 or 2 lakhs a month. These guys are starting to be very volatile, right? So can I quickly try a few experiments on them? Can I quickly see what kind of cutoffs, what strategies, what combination of variables are the most predictable for them? Can I test it out in production over the next 6 months in a champion challenger way? And then basis that, can I quickly come back and make some tweaks and keep doing this as a institutionalized process on a monthly basis? If you learn how to do that, and these companies are have started doing that, then in a year from now, when this becomes part of your company's DNA, you won't have to look back. Then the third thing that these guys are doing, again, as I alluded to earlier, is building out an early warning system for existing borrowers, right? What is an early warning system? It's a combination of models. So it'll typically be behavioral models, dashboards. So in the early warning system, these models will spit out some information. You've got to have a few very simple dashboards that allow you to quickly figure out what's wrong, right? Where's the red light? And then processes, which is basically around what do you do when you spot a red signal? Right? So models, dashboard, and processes that look at leading indicators of stress before a borrower defaults, right? So that's what, in a nutshell, these are the three big things that these top lenders are silently building out. Now what I'm going to do is talk. Let's spend the rest of the session talking about how we can do it within our company, right? One by one. Before we do that, though, I wanted to do something a little interesting. I want to run a quick poll. So I'm going to start this poll. You will see 4 questions on your screen, and each one of them has 3 options. I'd request all of you to please click the right option for these 4 questions. Let's take a minute or so. I'll read out these questions in case anybody has doubts, but please feel free to go ahead and in advance. And if you're done, please, there's a little Q&A button at the bottom of the screen. You can, if you have some extra time, please go ahead and submit any questions that you'd like me to answer at the end of the session. So I hope you can see all the other questions on your screen. The first question, do you think that your scorecards and policies developed pre-COVID are doing well in a post-COVID world? Okay, is it working well? Does it need updating? Or if you've already updated and you're good, please indicate that. Second question, I'll keep racing along. Does your credit risk toolkit allow dynamic tracking of vulnerable segments, simulations, and self-learning? Yes, it's all there. No, but we don't have enough data and all that stuff in our business, so this is not really important. And the last one is no, I need to build that capability. Third one is, do you have an early warning system for borrowers? Yes, I'm happy with it. No, but EWS is not that critical. And then no, you need to build it. And then the last one is post-COVID, do you think you need to further digitize your decisioning process, right? No. Yes, you've already done it. Yes, I want to do it, but I don't know how, or I haven't fully done it. Please take a few seconds and answer these questions. Also, I'll tell you that this session is getting recorded. So in case some of your colleagues could not join us, let us know after the session. There's our email ID here at Contact Us, and we'll be happy to send you a link or answer any questions that you might have. Okay. I'll just give 5 or 10 more seconds, then I'll close the polling. Okay. Let me share the results here. So basically, the first question, scorecards policies are working well or not? 20% of you have said, yes, it's working well. That's great. It's actually higher than what we saw when we did this 3 months ago. Half of you are saying it needs updating, and a third of you are saying that you've already updated. The second question, dynamic tracking, simulations, and self-learning. 1/3 of you are saying it's there, but the rest of you are saying that it's not there, and about half of you are saying you need to build it. Early warning system. Yep, I think 45%, that's a pretty good group. 45% is you're happy with it. About the other half are saying, no, it needs to be built out. And then digitization of your decisioning process, have automated decisioning with rules and policies, etc. I think most of us are saying that, so half of you are saying that we've done a lot of work post-COVID. The other half saying that we need it, but we haven't done it. So again, these results will be with us. If you need this, let us know. But I think basically what I'm getting out of this is there's about 35% of the people that are saying we've already got things in motion and we are somewhat there. And the other about half of people, 50 to 60% of the people are saying that no, we want to do it, but we're not there. So let's look at how to get there. Yeah. So I will first start with so let's go through these three pillars one by one, right? Let's first start with alternate data and AI models. So let's look at alternate data, right? What are the sources of alternate data? But before that, a quick note, right? So most of us are very used to using bureau scores, right? To as a critical piece of our decisioning and as for our cutoffs, right? However, needless to say, bureau scores have not been very effective during COVID, and for at least the next few quarters, they will continue to be less effective because our government has made some interventions like moratorium, etc., which kind of alters the natural credit cycle. And we all know that during moratorium, we didn't report the real good versus the bad to the bureau, so the bureau will be less effective. And then the bureau also reports with a lag, right? So once they report that somebody has defaulted, the data goes down, bureau keeps it, they store it, they run their scorecard. So I think that's one of the primary reasons why there was a huge push to alternate data, or is a huge push to alternate data during COVID. So let's look at what alternate data sources. I think the easiest and probably the most overlooked is your internal customer data, right? Take a quick look at your internal customer database and think through it. You'll find that there is a lot of very critical information that's already with you. For example, there's a long list, but just in the interest of time, I'll share a few. Employment information, right? We all know that certain industries have gotten hit harder by COVID than others, right? Airline industry, hospitality. If you have consumers that are coming to you for a personal loan and they are working in the airline industry or the supply chain of the airline industry, right? Suppliers or distributors, versus a healthcare industry, or if you have SMEs that belong to that industry, that there is a signal of whether the risk has gone up or not post-COVID. Payment history pre-COVID, we have seen that people who are spotless in their payments pre-COVID continue to be spotless 99% of the time. These people are very, very particular about their credit history going bad. They don't like to have these outstanding liabilities. However, people who are wobbly before COVID, they're good, then 2 months later they go to XTPD, then come back, then go to 30 and come back. Those guys have, in a large part, go really, really delinquent 90 plus post-COVID. So look at some of that history. Collections logs, right? Very, very few NBFCs actually do a good job of digitizing collections logs. What this is, collections log is basically keeping track of how much effort you had to spend during collections for every customer. So if you're looking at a customer that a year ago, you never had to notify them. They always paid 5 days before the due date. But then you saw that slowly they slipped into, they had to be reminded on due date. And now the last couple of months, you're seeing that you had to send an email because they're past due. So you kind of know that stress is building up, right? So if you have the right models to evaluate these and you're digitally capturing this data, that's a lot of good information. The second set of information is information you can get directly from the borrower. A lot of you guys are probably doing this. Salary slips, bank statements, financials for SMEs, for consumers and MSMEs. A lot of NBFCs are basically scraping with the customer's consent, scraping their SMS messages, where they get notifications from their credit card companies or payment credits, debits into their bank account or to their wallets, and using that to get a read on the risk of the customer. Now, what has happened in post-COVID is that companies who are doing these are getting these more and more digitized, right? So because of COVID, they wanted to create a zero-touch experience, and they wanted to virtualize and digitize most of these. So if you haven't done that, I think that's a direction you should look at very, very quickly, because these top 5, 10, 15% of these companies have already done that, and they're your competitors. And then the last bucket is data you can obtain directly from third-party sources, like your ITR, your GST, your telco utility bills. So there are companies out there that can get you log into their website, and then they'll get you your telco and utility bills for the last 12 months. And then the last one here is very interesting. This is something that I think differentiates certain NBFCs the most from the pack. And this is alliances and partnerships with e-commerce companies, payment gateways, POS, terminal providers, FMCGs, and lending to their supply chain partners. So if I want to lend to a Kirana store, right, or a bunch of Kirana stores in the city of Mumbai, and I have tie-ups with Procter & Gamble, Hindustan Lever, and Coke and Pepsi, right? I pretty much, and from their distributors, I get data on whether this Kirana guy, how much is he buying on a month, and is he paying on time? Or if not, then how much is his past due? I can get a very good read on 40% of his business just by these 4 or 5 FMCG partnerships. And I can lend against that. And that's an information that no one in my competition would actually have. This gives me a huge advantage over everybody else. So anyway, I wanted to cover some of the alternate data because I keep getting a lot of questions. Of course, there's more, but if you are getting all of this in a digitized way, you're probably better than 95% of your competition. So that's an alternate data. Now let's look at models, right? How can you enhance your risk models? I'll first talk about a simple way, and then I'll talk about the more complex way, right? If you haven't done the simple way yet, I think you should do it right away. And here's the simple way. Simple way is to say, let me identify 2 to 3 critical indicators of COVID impact. One of them here that I've illustrated is industry, right? So if you look at these industries in red, tourism, travel, airline, some retail, they have been impacted in a great degree, right? The y-axis is profitability impact, and the x-axis is liquidity impact. But if you look at pharma and health tech, on the other hand, they've been not impacted at all, right? So let's say industry is one dimension. So what you could do is, and there might be 2 or 3 other dimensions, right? So you might say that, look, certain pin codes, certain sectors like South Zone or East Zone have been impacted more, or tier 3 and 4 have been impacted less, tier 1, 2 cities more, or below a certain revenue threshold, I'm seeing a bigger impact from the really small merchants as opposed to the big ones. So pick 2 or 3 of these dimensions, and let's say you pick industry. Then what you can very simply do is say, look, I'm going to overlay a multiplier on my existing model for borrowers working in these industries. So if a borrower is working in pharma and healthcare, do nothing to your PD score. But if a borrower is working in tourism, multiply that by 2, or I just picked the number 2, multiply it by 30%, 1.3 times. And then somebody who's in the middle, multiply it by half of it, right? So really what you're doing is overlaying a weightage and magnifying the PD of the vulnerable industries. Similarly, like I said, you could use a couple of different dimensions and overlay that on your models. But what the top 10% of these guys are doing is really using this opportunity to understand and see how they can move to machine learning and AI. Okay, and they're using AI in a very cautious way, a little bit at a time, to more accurately predict risk. So there's a lot of, it's a very lengthy conversation we can have to describe why AI is better than traditional regression models or Excel-based models. We can have a separate discussion on that if you're interested, because Synaptic, we are in the field of AI. But what I wanted to do here is really talk about at a high level, why does ML or AI work better than traditional regression models? Because I keep getting that question a lot. So the first point is there are nonlinear multidimensional relationships between your input x1, x2, x3 and the output variables, the y, which is 30 DPD in 4 months, etc. in an Excel model or in a basic model, you can't really capture these non-linear relationships. Or if it's multidimensional, right? If it's not y is equal to ax1 plus bx2 plus c, right? If it's three-dimensional, nine-dimensional, AI is able to capture it better. Second, these independent variables are actually not independent, right? Salary and your bureau score or delinquency on bureau is not independent, right? If you stop getting your salary, there's a good chance you'll be delinquent sooner or later. So there are tricky correlations among these input variables, which a basic traditional model is not able to figure out as well as an AI model is. Right? A third one, and I'll stop with this third one because there's a lot more. There are hidden patterns in the data that AI can identify into natural clusters and say, oh, these customers all have a lot of similarities. And then, but this new customer comes in and says, oh, but this guy should belong to this cluster, but he's an outlier. So a lot of outlier identification can be done through unsupervised AI models, which is impossible to do with traditional regression models. So and there's a lot more. The list is much longer, but essentially what AI does in terms of business impact to you is it is a sharper knife to identify the good from the bad customers ahead of time. With that sharper knife, it can look at your approved population and say, well, these are the customers that are actually risky. I looked at all these alternate data and put it all together, and I realized there are some signals that say this is risky. Get these guys out, don't approve them, right? So it helps you improve your portfolio quality by getting rid of your highest risk customers that a traditional model cannot do. But that also reduces your size, right? Your approval rates and portfolio size. So what AI does to balance that is you can run it on your rejected population. And AI will comb through that and say, oh, but these are some good guys from your rejected population who has a 30 DPD less than your average portfolio average. So pull them in. So ultimately, if the green ones are bigger than the red ones, then you actually have a bigger growth, bigger population, bigger portfolio, as well as a better quality, right? So more about AI maybe later on in a different webinar, but I think you should seriously look at AI because some of these top 5-10% of the companies have already taken that plunge. Next, let's move to test and learn environment. So let's see what these companies are doing from a test and learn standpoint. I'll talk about 2 or 3 things that they're doing, and then we can discuss in more detail later on if you're interested. So basically what these companies are doing is setting up different tests to test their approval strategies very, very quickly and dynamically, and then making some changes periodically. Here's one thing that they're doing as an example, right? You can do, which is stress testing your segments. Basically, conceptually, it's very easy. You can do it manually, but after a while, it gets overwhelming. So you need some kind of a tool and a platform to do it. But what this means is you analyze how different variables are impacting the performance of your different segments and subsegments, right? So you divide your customer base into a few segments, and then do you have an environment where you can quickly run a scenario and say, look, I want to increase my stable cutoff from 700 to 710 for this subsegment. How easy is it for you to quickly draw a line around that subsegment, apply a higher cutoff only to that, and do a back test, right? So on your existing books for that subsegment, can you quickly upload them in some table and then say, okay, I want to run this new strategy with 710 cutoff. Now let me see how did my approval rate go down, and what about my bounce rate? Because you have the actuals for these customers. So quickly run different stress tests and figure out, okay, 710 is good, or maybe 720 is good. Now let me deploy that in production, right? In a champion challenger sort of way. So these NBFCs are building out these kinds of toolkits and to allow them to do all these analytics without wasting a lot of analytical horsepower doing Excels and manual. Right? The other one here is risk appetite framework. This is really to say, okay, I want to, for different segments, I want different cutoffs using some bureau variables, some geolocation, financial variables, some demographic variables, time in business, et cetera, and really try to do use different variables or combinations and say, okay, this segment is a low risk segment for me. Maybe I can approve them a little bit more. But the high risk vulnerable segment, I want to increase the cutoff and approve less. Now, if I join those two, how does it now look for my overall portfolio standpoint? Very interesting things to do, but traditionally we've sucked up a lot of our analyst time doing this. Now, there are tools and platforms available where you can actually do this on the fly very, very quickly. And these companies are actually adopting those tools. Here are a few more things that these guys are doing. I talked about tracking vulnerable segments. I talked about easy simulation toolkits. So what if analysis, really figuring out different segments and running different experiments on them. Champion Challenger, I think some of you would already know what a Champion Challenger is. If you don't, but basically what it is, let's say you have a approval strategy running on a certain segment of your customers. Let's call that your base strategy or a champion strategy. You think that there might be another strategy that might get you better risk reward balance, right? It could be a simple cutoff change. It could be, oh, I used to mostly use bureau, now let me use bank statement. Or for my larger customers, let me use GST. So you quickly create some variables out of GST, but you're not sure whether that's actually going to be good or not. You can do back testing, but history never repeats itself, right? So what do you do? And you won't know until you have actually lent against that new strategy and compared it. So Champion Challenger is a technique, and some tools allow you to do that automatically, where you can say, look, I want to actually put my champion strategy as well as 2 or 3 challengers, right? A conservative challenger, a GST-based challenger, and some other challenger. And I want to tell my system that, hey, randomly send 95% of my applications through champion strategy, so I don't bet my books, but take the other 5% and divide them into 3 and 2 and 1, or whatever, into the different challengers and let them run. So you'll let them run, you'll lend against them. After 3-4 months, you'll have enough of a portfolio on them. Then people will start paying, and then people will stop paying. So it'll take us some time, about 6 to 9 months. But then you'll start seeing some of those challengers working better than the champions, others not. So then the toolkit should allow you to go back and say, okay, I want to increase the tap to challenger 1 because it's going better. So instead of only sending 5%, I want to send 20% to them. Challenger 2, I'll stop. So basically tools that allow you to do that very dynamic. And then the other thing, and there's a long list here, but I'll stop with this one, is risk-based pricing and limit. So basically, today's world, everybody has shut down acquisitions for a while, and now they're growing, right? Now, with every growth, you think, right, and you're nervous, saying, okay, now my approval rate is 20%. I want to grow it to 25%, but and I kind of know out of my 80% that I'm rejecting, who are the top 5% lowest risk people based on my scorecards. But can I lend to them? How much should I lend to them? And can I actually lend to them a limited amount, but charge them a higher interest rate so it covers up for the extra risk I'm taking? How do you do this trade-off between risk and reward on some of your riskier portfolios on the fly? So these NBFCs that I'm talking about, these 5 to 10%, have invested in tools and processes that allow them to do this very quickly without a lot of manual effort, and do it repetitively, and through dashboards track them. And then once you do it monthly, over a few months, you get a very good handle of how to find the right balance on the price. And okay, so that was test and learn. Now let's go to early warning systems. Again, I explained the concept of early warning system. It's not new. I think 30-40% of you guys already have some kind of an early warning system. But about 50-60% of my clients actually have an early warning system. But when I look at how good they are, how robust they are, there's a wide difference. So in this slide, what I really want to do is talk about what are all the different pieces of early warning system that I've seen clients have. And you might think that you have one, but you might realize that you only have pieces of it. So the rest of it might be useful to you. So first of all, here's the data that comes in as input to the early warning system. Almost everybody that has an early warning system uses account performance data, right? So last 6 months to 12 months of data that says, how has each account been performing on your books, okay? Basically delinquency-wise, right? But then you look at account performance and you see, okay, there's lots of other things you could be looking at, right? Time on book. So there are some, let's say, in a lot of the affordable housing loans, if you really look at trends, you'll see that the first year, 2 years, people are paying on time, and then they start defaulting, right? In the years 3, 4, and 5. And folks that have actually made it cleanly at the end of 5 years, usually they're pretty good for the rest of their tenure, right? So years, time on book, and remaining tenure are good variables for that kind of a business, right? Utilization, balance forward. Again, there's 20, 25 variables that we know are very, very predictive in different circumstances. So it's not just using account performance, but really figuring out what variables are useful. And AI actually helps you figure that out, because manually you have to do a lot of permutations, combinations to figure it out. But that's one data set. The other data set that about 50% of our clients use is bureau scrubs. So some of them have found it quite useful, others haven't. But mostly every 2 to 3 months, they get CIBIL scrubs, where it tells them about off-us performance, right? And for some products, it's very good because you typically default on certain products before you default on other products, right? So if you're actually lending out somebody an LAP where you're actually securitizing a big asset that they have, they probably won't default on you early on. But if you look at the bureau and see them default on their smaller unsecured loans, then that's a good leading indicator. And then the last data set, which rarely our clients use, but again, this could be very useful, is your collections logs and interaction data. I was telling you earlier about an example of average reminder calls or notifications that you had to give to a person before cure, right? And how's the trend, longitudinal time series trend of that? And does that trend indicate that stress is building up? Interaction channel preferred, reminder, mail, click through. Again, there's about a dozen or 2 dozen variables here. So these are the 3 data sets. Now, obviously, these 3 data sets are very different. So manually building a model, very, very difficult. Again, it's a good start, but ultimately these advanced guys have all built AI models, behavioral AI models, where they let it learn from the last 5 years or 2 years of data, all these different kinds of data, and the AI machine learning algorithms built a model. And the model actually outputs a risk score. Let's say on a scale of 1 to 5 or 1 to 10, it says, okay, these guys, based on my historical data, is very high, at very high risk of going downhill in the next 2 months. That's my early warning prediction. So if you're 8, 9, or a 10, you're very high risk. If you're 1, 2, 3, you're low risk. And then you can actually set up your AI models to also give the top risk reasons. So you're not left wondering why this guy is a 9 on 10. Because the engine gives you, the platform gives you the top 3 or 4 or 5 reasons that says, okay, because his bank balance of this has dropped and then this has dropped. So you can quickly see and say, okay, I need to really give him a call because he is really red. So that's what they have invested in, right? Different data sources, different AI models that come up with an early warning score. And basis the score, these NBFCs do a bunch of different things. So if your score is 1 or 2 or 3, that means you're not at risk at all. Then maybe it's an opportunity for you to upsell that person something, right? Maybe if he's a very good guy, he's going to pay back, he has liquidity, sell him some more. But if his risk is a little bit higher, you can probably offer him a 3 or 4 month moratorium because at the moment he just doesn't have cash, right? Maybe it's that seasonality in his business. Or you can consider increasing his tenure and dropping EMI. And if it's really, really long-term and critical customer who's a lot of stress, maybe loan restructuring. And if you're in a 9 or a 10 on 10, then at least the early warning signal tells you 2 months before that somebody is going to go into collections bucket, right? So that's the extent of what people have done. Of course, I'm just skimming through the top high level, but there's a lot of detail in this, but this is where the investment has gone into the early warning system. Okay, so so these are the three things. So I covered those three topics, right? Early warning system, AI, alternate data, and then a experimentation tool. Let me tell you, let me just show you this one slide, basically to prove to you that what I've been talking about is not just PowerPoint crap. Right? This is a real example. And I'm sure there are lots of real examples like this, but this is with one of our clients that we've helped them over now a 1-year period. This is a SME lender, and the particular product that I'm talking about here is their small ticket unsecured loans, right? So they give really small loans to truck drivers or kirana stores or small mom and pop shops. The way to read this chart, y-axis is the approval rate, right? That is, of every 100 applications, how many do I approve? So obviously, if you go up, that's better. That means you're growing faster. The x-axis is the 30 DPD percentage. So if you move to the right, your 30 DPD increases, which is not good. So you want to move to the left and you want to go up. Okay. This is where the client was in the beginning. So they had a 35% approval rate and a 3.1% 30 DPD. Remember, this is a small ticket, high volume business. We were able to move them. And so they adopted a few things, not everything, but half of the things that I talked about. And we moved, they moved to this curve. What does that mean? That means that if you really look at these two bubbles, right? So if you're okay with your 30 DPD rate and you say that, look, Synaptic, I want to really grow, okay? Then you move from here to here, which means your 30 DPD stays at 3.1. Your approval rate goes from 35% to 58%, right? On the other, which is a great jump, right? More than a 50% jump. On the other hand, if you're saying, no, I'm making losses in this business, I want to turn myself around, I don't want to approve any more customers, I just want to use AI and whatnot to weed out bad customers and replace them by equal number of good customers, which means my 35 stays at 35, but the 3.1 dropped to 2.3. So these are real numbers, guys, right? The only thing is, so two things I wanted to tell you. This was achieved through a combination of AI and constant learning, testing and learning, right? So and a little bit of alternate data as well. So they really used one additional alternate data source. They moved their bureau model to AI, and they did a lot of test and learn. We had to help them for the first 6 months to figure out what charts to look at, set up the charts. And then after that, the client was self-sufficient. They knew exactly when to have their monthly governance meetings and weekly tracking meetings and what to look at and how to react. The caveat is this is not quick. This is not easy, right? Tools and techniques can make it easy for you, but this is a game of discipline. It took this client almost a year to get to this point, okay? Because, just to move the model to AI, great, but you have to lend against it and then see that it's improving. That takes 6 months. Then to really do the test and learn and do experiments, it takes 3 to 4 months of a lot of effort to actually deploy some of these experiments and then track them and change them. And so by the time you start seeing results, it's like 8, 9 months or even 12 months. But once you start seeing results, it's very, very sticky. Because remember what's happening here, results are an outcome. The way you get to this by doing some of the things that I was talking about, AI, putting an AI model, that AI model will learn over time, right? Because AI is self-learning. So every 3 months you put in new performance data, it automatically refreshes and gets better and better. It's very hard for it to go backwards. Similarly, if you're looking at some dashboards and have set up some experiments to quickly figure out which segments are not performing and change them, and you've put together a rhythm that says every month you look at this and do this, the next month you look at that and do this, unless you break that rhythm, you only get better and better over time. And it's that much harder for your competition to actually catch up because they need a year or two to build that out. So, so this is real, guys. So let me just end with this recap slide, what we've talked about today, and then I'll open it up to questions. What talked about today is, how AI models and the importance of AI models, alternate data, and the whole bunch of alternate data that you can look at, how to build, test, and learn, and what kind of testing and learning to do. And the tools are there to help you do that. You need to decide what to do, and then how you build an early warning system. What data sets do you use? What models? How can AI help? What's the output, and how do you then react to the output of the early warning system? So that's really what I had, guys. I know I rushed through this a little bit, so I'm happy to take some questions if you didn't follow something, or if there's something specific about your business that you'd want me to address. You can always write to us at contact us, and we'll respond, and we can maybe set up some time or respond through email. But let me just pause here and see if there are any questions. I already see 6 questions here, so I'll start answering them. But please let me know if you have any questions. I'll see how many I can answer. Does Synaptic have the experience in dealing with these issues in real life situations? And has Synaptic built out solutions for customers? That's the first question. Yes, we have. And like I said, I showed you the example. Typically, our clients don't use everything that I've mentioned, right? These are all best practices from multiple different clients. It is very difficult, change management-wise, to actually deploy all of this together. And we've seen companies struggle. They tried to do a lot, and then they couldn't cope up with it, and then they had to pare it down. So yes, we have helped clients on all of these areas through a combination of platform and services, consulting help, and sometimes you can just call us for help. We won't charge you for a phone call. So we've helped. I think more on AI. A lot of people are doing AI and the test and learn kind of platform. Second question. My target customer segment has no data. ITR, GST, financials. Is testing and learning and AI possible? Okay, this is a very good question. Actually, I get this from a lot of MSME customers or folks that lend to MFI or tier 3, 4 plus cities, right? They don't have any income tax returns, bank statements, GST, but it's absolutely possible. So here's how you should look at it, right? Let's say you're lending to the bottom of the pyramid, small shop owners, right? They don't have any GST or anything, bank account, mostly cash. But here's how we tackle that, right? Synaptic has built a lot of scorecards, and we know what kind of variables, demographic variables, are critical to risk for different kinds of segments. But let's say you have identified that, okay, there are 20 variables, size, the number of footfalls, what kind of business you're in, which locality and pin code, etc., geolocation, etc. What you could do is, today you might be taking all of that in a pen and paper or typing it in an Excel form, and your underwriters are using their judgment to then underwrite this person. What we suggest is you go backwards. You first find out what variables out of these and what ratios are most predictive of risk. Okay, come up with these 15, 20 ratios. Then go backwards and say, okay, to get to these ratios, what are the individual items I need to capture in my questionnaire, the RM questionnaire, the field visit, or the televisit questionnaire, or for consumer lending, for what should be there in the application form, right? And then you say, okay, can I build this into a quick screen, maybe a mobile, a tablet app for my RM and a database? So, he has all these 20 questions he's answering, filling out. And then when he fills it out, put a drop down. See, when we build scorecards, so let's say there is turnover is a variable, right? And we have, in the scorecard, you'll typically have brackets, right? Less than 1 lakh a month, 1 to 3 lakhs, 3 to 10 lakhs, and over 10 lakhs. So have the RM build out that app in a way that he actually selects one of these. Once he does that for all the questions, you pretty much have a data that can auto-populate into your scorecard. You don't need a whole lot of other tools. It's just a simple screen or an app, database, and some connectors to connect that to and execute your scorecard real time. Yeah, and then basically collect that data and track it. Most of my clients don't do a good job of collecting that. The data is very powerful, even if you don't make very different scorecards in month 2 or month 3. Just collecting that for 6 months allows you to do a lot of back testing, allows you to move to AI after a year if you have 10, 20,000 records and so on. So absolutely, AI is possible. If not today, then a year down the road, but start collecting the data. And you can do test and learn somewhat manually, maybe initially. Or if you take a tool, you can do that. Shouldn't we have had these early warning indicators before the crisis? How will they help me in the next crisis versus just reacting now to the one that has already hit? I think hopefully now, this question came in very early, but I think hopefully now you've probably figured out that all of the things that I've spoken about are not just COVID related, right? These are all hygiene metrics, hygiene things that will definitely improve the amount of smart analytics in your system, company, right? Smart analytics, by smart analytics, I mean not just analytics for the sake of analytics, right? Analytics to actually get to solve a use case in a very focused way without wasting too much of resources. Automating not for the sake of automation, but for the sake of arriving at answers very nimbly and in an agile way. So absolutely, it should help you guys before, even after COVID. How FMCG is impacted? Okay, I think we should probably have a little bit more detailed discussion on this. Clearly there are certain segments within FMCG that are impacted more than others. The daily necessary wear, right? Soaps and Procter and Gamble, etc. type of FMCG is back to normal now, right? When I look at some of the distributor and the wholesaler reports, those have bounced back. But certainly some of the other FMCG items that are more, on the foods side, beverage side, perishable stuff, not the daily perishables, they have taken they're still recovering. A lot of people are starting to spend now, spending on two-wheelers and fridges and TVs are going up, but it'll take a while. But again, I think this, instead of me blabbering here, I think there are reports out there that tell you how FMCG is impacted. And the question is, basis that, what do you do, right? Can you tweak your models and put an overlay risk indicator based on the subsegment that a customer is in of FMCG, given how that subsegment got impacted? You can do that. Or you can carve out, you can say that, look at certain segments, whether it's FMCG, I'm generalizing this question now. Try to come up with certain segments that you think may be vulnerable. Carve them out separately. And then hopefully you have a system, if not, get a system which allows you to set them up separately, apply different rules to them, track them separately, and track them, right? Because it's always 80-20. 80% of your losses will come from 20% of your customers, right? Or even less than that. If you can identify that, then technology can help you do all the things I talked about, right? Test and learn, etc. So I think that's what's most important. Can we dwell a little bit about how AI models and alternate data can help wholesale lending, especially project finance? Yes, and I'm not sure who sent this question. I'm sorry, but can we? I know the bulk of this audience is may not be interested in this, but I'll just give you a quick answer, and then maybe we can have a separate follow-up session where I'll be more than happy to get on maybe a 30-minute discussion with you and answer your specific questions. On project finance, right? It really depends on the products that you're having, and who you're underwriting, right? If you're underwriting the large builders, for example, versus their suppliers, the dynamics become very different, right? If you are financing certain parts of a project that are somewhat hypothecated or securitized, then it's a little bit more asset-based. So instead of really answering the question at an overall level, I would request that, can you please write to us, and then we'll probably get into a more detailed discussion on your specifics. How do we scale our AI models? So actually, AI models are much easier to scale than traditional models. I don't know specifically what part you want to scale. I think most of the questions that I get on AI models is more around, okay, if I get more data, then how can I really refresh my AI model with this new data, whether it's data about new types of customers or additional time series performance data about the same customer. It's very easy. You just have to set it up in a certain way and the AI model can self-learn periodically over time. That's one of the big reasons why you want to go to AI, as opposed to a traditional model where you have to manually scale it. I hope that's the meaning of scale. If not, again, I'll, for the interest of the bigger group, maybe we can take it up in a smaller way. FMCG alternate data sources, how easy are such data sets to get? How can you guys help on this? How we can help on that? Maybe again, that's a one-on-one discussion we can have later. How easy it is to get? So let me just spend a minute on this one, right? So basically what you should do, if you want to tie up with an FMCG and get alternate data from them, remember that if you're lending to a distributor of an FMCG, of course, their business is fully leveraged to that FMCG partner, anchor partner. But if you're lending to retailers, only a small percentage of their business comes from this particular FMCG, right? Selling Coke or whatever, right? Rice. So what you need to do is focus on a geography. Let's say you take Maharashtra as a state or Bangalore as a city, and you kind of tie up with distributors of multiple FMCGs. You'll see that the same distributor of Coke supplies to all retailers in a certain segment, certain location within Bangalore. So within that segment, you should tie up with multiple FMCG distributors. And then you have pretty much a grasp of 70–80% of the business of the Kirana guy. So, and I mean, I'll be happy to connect you to some of them, but I think let's have a more detailed discussion on what's a realistic way of doing it in an easy, so you can get quick results, as opposed to you strike a lot of partnerships and see nothing after a year. Okay, I think there's a long list of questions. I'm really happy that a lot of you guys have sent the questions. If you have sent your names with the questions, we will definitely respond to you. We have your email ID. We will respond to you with an answer. And then if you want to have a follow-on session with myself or somebody else in our team, we will be happy to set that up. There is at least 15 questions here that I think we're out of time to answer. If you haven't, if it's an anonymous question, then we unfortunately don't have your details. If you could write to us in this contact us at synaptic.com with a very specific question. If we'll answer it over email if we can. Otherwise, we'll be sure to kind of set up some time with you with the right person within Synaptic and make sure we address your question in your context. Okay. Wonderful. Thank you very much for your time and for your questions. It was certainly a pleasure answering some of them. I know we're at the end of the hour. So again, thank you very much. And hopefully we'll connect with some of you again soon in our next webinar. Thank you, everybody.